India ETF flows hit record in 2023. Can the bull run survive 2024? In 2023, India's exchange-traded funds, ETFs, experienced a historic surge, attracting a record inflow of $8.6 billion. This exceeded the previous high of $7.4 billion set in 2021, signifying a burgeoning appetite for Indian equities among global investors. But as we enter 2024, with the crucial general elections looming and global economic headwinds swirling, the question arises: can India's ETF momentum endure? Several factors fueled the record ETF inflows of 2023. 1. Strong economic growth. India boasted the fastest GDP growth rate among major economies, projected at 7.3% for the fiscal year ending March 2024. This economic dynamism, fueled by domestic consumption and robust exports, painted a compelling picture for investors. 2. Outperformance of Indian equities. Despite global market volatility, the Indian stock market registered exceptional performance, with the NSE Nifty 50 index soaring by 20%. This outperformance compared favorably to other emerging markets, particularly China, whose growth was slowing and further attracted investments. 3. Election optimism. Prime Minister Narendra Modi's Bharatiya Janata Party, BJP, secured victories in key state elections, bolstering hopes for political continuity and stable policy frameworks. This prospect, in contrast to election concerns in other emerging markets, further fueled positive sentiment. 4. Diversification appeal. With global uncertainties clouding the outlook for developed markets and concerns over the China-US trade war, India emerged as an attractive diversification option for investors seeking exposure to high-growth emerging markets. 2024 outlook, a nuanced perspective. While the outlook for India's ETF inflows in 2024 remains positive, it's crucial to consider potential challenges and headwinds. 1. Political uncertainty. The upcoming general elections, due by May 2024, are bound to inject volatility into the markets. While Modi's potential re-election could maintain confidence, any unforeseen outcome could trigger temporary pullbacks. 2. Global economic factors. The trajectory of the U.S. Federal Reserve's monetary policy and its impact on global liquidity will significantly influence foreign capital flows into India. Rising interest rates in the U.S. could lead to an exodus of funds from emerging markets, including India. 3. Geopolitical risks. Escalating geopolitical tensions, such as the Ukraine war or potential conflicts in other regions, could induce risk aversion and dampen investor sentiment towards emerging markets. 4. Domestic challenges, inflationary pressures, potential supply chain disruptions, and the government's ability to implement key reforms could impact the Indian economy and its attractiveness to foreign investors. Reasons for optimism here. Despite the aforementioned challenges, several factors suggest continued optimism for India's ETF inflows in 2024. 1. Structural tailwinds. India's long-term growth drivers, such as a young and burgeoning middle class, rapid urbanization, and government initiatives like Make in India, remain compelling. These factors are expected to underpin economic expansion regardless of the short-term fluctuations. 2. Valuation gap. Compared to other developed and emerging markets, Indian equities still offer attractive valuations, leaving room for further upside potential. This could lure value investors seeking opportunities in a volatile global market. 3. Reform momentum. The Indian government has taken steps to improve the investment climate, streamline regulations, and enhance corporate governance. These efforts, if sustained, could further boost investor confidence. 4. India's unique appeal. As an emerging market with a large domestic market, diversified economy, and strong democratic institutions, India offers a unique proposition for investors looking beyond China and seeking exposure to high-growth regions. Investment strategies for 2024. In light of the nuanced outlook for India's ETF inflows in 2024, investors should adopt a cautious and diversified approach. Focus on long-term fundamentals. Prioritize investment in sectors with consistent growth potential, such as consumer staples, healthcare, and technology, rather than solely chasing election-related themes. Active management. Consider actively managed ETFs or mutual funds led by experienced portfolio managers who can navigate the volatility and identify undervalued opportunities. Diversification. Maintain a diversified portfolio across various asset classes and geographies to mitigate risks associated with any specific market or sector. Regularly reassess. Stay informed about evolving economic, political, and global conditions and adjust your investment strategy accordingly. The record-breaking ETF inflows of 2023 highlight India's burgeoning appeal among global investors. While 2024 presents both challenges and opportunities, India's long-term growth potential, attractive valuations, and unique market proposition suggest that the bull run is not likely to end overnight. However, navigating the Indian market in 2024 will require a nuanced approach. Investors should prioritize long-term fundamentals over short-term election bets, actively manage their portfolios, and maintain diversification across asset classes and geographies. By remaining informed and adaptable, investors can capitalize on India's immense potential while mitigating the associated risks. Beyond the factors mentioned earlier, several additional reasons support continued optimism for India's ETF inflows in 2024. 1. Rising disposable incomes. India's middle class is expected to reach 500 million by 2025, driving up domestic consumption and demand for goods and services. This consumer boom will benefit various sectors, including consumer staples, retail, and healthcare. 2. Government reforms. The Indian government has undertaken several initiatives to improve the ease of doing business, attract foreign direct investment, and boost infrastructure development. These reforms, if effective, could further propel economic growth and attract more foreign capital. 3. Technological prowess. India is at the forefront of the global digital revolution, with a thriving IT sector and a rapidly growing startup ecosystem. This technological prowess positions India to benefit from the ongoing digitalization trend and attracts investors seeking exposure to the future of technology. Despite the reasons for optimism, investors must remain cognizant of potential risks and challenges that could impact India's ETF inflows in 2024. 1. Geopolitical tensions. The ongoing war in Ukraine and potential conflicts in other regions could trigger risk aversion and lead to capital flight from emerging markets like India. 2. Global recessionary risks. A recession in major economies like the US could dampen global demand, impacting India's exports and economic growth. 3. Domestic policy uncertainties. Populist policies or fiscal imbalances implemented by the government could raise concerns among investors and affect market sentiment. Conclusion. Leo. India's ETF inflows in 2024 will likely be shaped by a complex interplay of domestic and global factors. While the outlook remains positive, investors need to adopt a cautious and well-diversified approach, focusing on long-term fundamentals, actively managing their portfolios, and staying informed about evolving economic, political, and global conditions. By doing so, they can navigate the potential headwinds and capitalize on the immense opportunities that India's vibrant and dynamic economy offers. In conclusion, the Indian market presents a compelling investment proposition for those seeking exposure to high-growth emerging markets. By carefully considering the opportunities, challenges, and risks, investors can position themselves to benefit from India's long-term potential while mitigating the associated volatility. As India continues its ascent on the global stage, its ETF inflows are likely to remain a key indicator of its economic progress and investor confidence.